We are seeing significant problems in the banking sector globally. We're seeing specific problems with Bank of Montreal that we're going to get into in this video, and also CIBC. And banks are beginning to wake up and see that the amount of people struggling could really impact their business harshly. So let's get into it. And first of all, start off with this article from Financial Post. So Canadian banks say borrowers showing strain of higher for longer interest rates. Now, obviously, we had the interest rate cut that happened last week. I mean, how much of an effect is that really going to have? 25 basis points going from 5 to 4.75, probably to 4.5 in July. Still, is that going to have a dramatic effect? I don't think so. It might have an effect on the euphoria in the housing market, although I think even there, things are going to be very, very limited because of the data that we've seen over the past couple of months. But it's very interesting. So we'll get into what's happening here. And it is just crazy. So borrowers whose mortgage amortization periods lengthened as interest rates soared are making lump sum payments to get back on side. But the pace has slowed at the Canadian Imperial Bank of Commerce, one of several signs from Canada's biggest banks that borrowers are feeling the strain. Yeah, we said this was going to happen years ago. You know, they keep ratcheting up their loan loss provisions, which we're also going to get into. But they have hundreds of billions of dollars of loans outstanding that could be potentially bad loans, especially these loans that are negative amortization. I mean, it's not as if this hasn't been done before. That's why it's so funny. It's just like repeating the same thing, expecting a different result to what happened in the US. I mean, it's just unbelievable. So anyway, let's continue on. So CIBC Chief Risk Officer Frank said 90-day plus delinquencies were rising on credit cards and unsecured lending. He also agreed with an analyst who noted that while the amount of negatively amortizing mortgages continue to be reduced through the end of April, the pace of those reductions has slowed. Some who declined to make these voluntary payments recently would have been the ones who could not afford to do so. But the bank also noticed that some borrowers appeared to be holding back in anticipation of interest rate cuts. And again, I don't know if you watched the Bank of Canada's press conference. I mean, I had to keep nudging myself to keep myself awake because it was just so boring. And I don't like talking about the Bank of Canada so much because they don't really control everything like you're led to believe. But the Bank of Canada even said in that press conference that the return to pre-pandemic interest rates is likely not going to happen. So they are anticipating that rates are going to remain higher than they were before the pandemic started. So, you know, interest rate cuts, how many interest rate cuts are they looking for? And again, even if like the Bank of Canada is cutting 100 basis points, 200 basis points, that is going to be in response to a terrible event that is going to affect those people as well and offset any of the rate cuts that are honestly happening. So it is sort of ridiculous. Just all these people thinking, oh, yes, the soft landing is in sight. And they even said that too in their press conference. Very, very funny as usual. So Bank of Montreal, however, ratcheted up expectations for impaired loan provisions over the remainder of 2024 after outstripping analyst estimates for credit loss provisions in the second quarter reported earlier this week. So we'll get into BMO in a minute here. I just want to quickly cover this. The Bank of Canada lost $934 million in the first quarter. And, you know, you can get into this, but they basically had this loss of $934 million in the first quarter of 2024 because of their bond holdings. And if you go down, it actually says that the central bank recorded net losses of $1.1 billion in 2022 and nearly $5.7 billion loss in 2023. But prior to that, it had been profitable, remitting $2.4 billion to the federal government and nearly $2 billion in 2020. We have to ask the question, question, is the Bank of Canada really achieving any of their objectives? I mean, they're having all these losses and all these gains, which they obviously pass on to the taxpayer either way. But the funny thing is, when you think about what they've done, are they really fixing any of the problems we have? Absolutely not. In most cases, they're just making them worse. They're just exacerbating those problems. And we know from what the Bank of Canada has done with reducing interest rates that that was likely in response to what is going on in the banking system, particularly when it comes to commercial real estate. We've covered this time and time again, but another fund is halting redemptions. And this is on a private debt product. And obviously in Canada, private debt is 270% of GDP. It's one of the highest in the world. So if one country is going to have a problem with private debt, it's going to be Canada. And for those of you that don't know, private debt is just debt held by corporations, businesses, things like that. And that debt is issued through funds like this. And we're talking about the more risky products here. But still, if the people are cracking who are more risky, who is next? Who is next? That's my question. It's just so logical, but nobody sees it until it's too late. But anyway, let's continue. So Nineport Partners LP will stop paying cash distributions on 3 private debt funds that collectively manage $2 billion in assets, in quotation marks, I would say, and will also skip the current redemption window on its flagship private debt fund, preventing investors from cashing out in the second quarter. I mean, imagine if you're holding that, you're going to be pissed. Toronto-based 9Point informed investment advisors this week that it will stop paying cash distributions on the 9Point TEC Private Credit Fund 2, which is also co-managed with Third Eye Capital. God, these names. After reviewing our various liquidity options, Nineport Partners and our sub-advisors have determined that the best path forward is to preserve liquidity and balance the long-term goals of these effective funds. So I mean, that does not sound like a good thing, does it? If they're halting redemption, they're talking about liquidity being an issue. Yeah, it really doesn't sound good. Do you think that 25 basis point interest rate cut that the Bank of Canada did is going to make all that difference? I don't think so. I mean, it's getting really funny now. That is one thing that we can at least laugh about. So anyway, reviewing various options with the aim of creating liquidity for the fund, adding that at this time, liquidity generated will be used to honor ongoing commitments to portfolio companies to stop them going bust, essentially, satisfy the fund's redemption provisions, and meet operational requirements. Private debt managers in Canada raise money from investors, often retail investors, and then lend these funds out to borrowers who are unable to obtain traditional bank financing. In exchange for lending to higher risk corporate borrowers, investors have historically received outsized monthly payouts that amounted to about 8% annually. So the amount of cash that the person is putting into that deal is a lot more than, say, it would be if they were going through a traditional bank, and that's to satisfy these funds. But in commercial real estate, office values are falling so fast that all these funds and the LTV ratios are just completely upside down. I mean, they can't value it quick enough to even show what the LTVs would even be at this precise moment in time when you're seeing office buildings that are selling for $1 all over the place. So lately, however, some higher risk borrowers have struggled with much higher interest costs. Many loans offered by private debt managers are provided at variable rates, and these have become more expensive for borrowers, just like variable rate mortgages. It's exactly the same thing. And like I said, guys, ask that question, who's next? Who is next? It goes from the worst to not so bad to the good credit people. That's the way it works its way through the system. The pain is spreading across the industry. In all private debt funds that manage nearly $10 billion have struggled with elevated redemption requests or major defaults. And funds managed by companies such as Romspen Investment Corp, we've covered that a while ago, and Hazelview Investments have halted redemptions. Canada's private debt sector was also dealt a major blow in 2021 when Bridging Finance Inc., which managed $2.1 billion mainly from retail investors, was put under the control of a court-appointed receiver, essentially going bankrupt. While the roots of Bridging woes are potentially different, 3 of its lenders have been accused of fraud. Investors still suffered and are expected to lose $1.3 billion. So it's a $2.1 billion fund, and they're only going to get $1.3 billion back. Where on earth did that $700 million go? To end this, it arranged a $100 million credit facility with the Bank of Montreal in April 2023. And might I add that the Bank of Montreal is having problems. If these funds are having problems and they're running to the bank and the bank's saying, yeah, we'll lend you money, if they're not paying back that money, the risk is just being transferred more to the banks as well. And because the banks are so monopolized and centralized in Canada, we only have 5 big banks in Canada. That means that essentially you have most of the risk on those 5 big banks. I mean, the smaller ones like EQ Bank, for example, they don't even offer credit cards. So it's just kind of insane. And that's probably a good thing, by the way. I think EQ Bank has done a good thing by not doing that. So anyway, we can get on to the net write-offs here, which was put on X by Hanif Bayat here. I hope I'm pronouncing that right. So again, the loan write-offs, the amount of loans that have gone bad just keep going up and up and up and up. And you think about the credit loss provisions, and you know, Scotiabank has nearly $1 billion of loan write-offs going on right now, and their credit loss provisions, where are they? They're probably in the hundreds of millions. So you got to ask the question, there is something bad that is going to be going wrong over the next couple of months, and the Bank of Canada cutting 25 basis points here and there is really not going to make any material difference to this. The only thing it might affect a little bit is just how euphoric people are in the housing market. But other than that, and I think that is going to be a negligible impact as well, I don't think it's really going to do much. And after BMO reported its earnings, stock dropped, and it's still dropped. It hasn't really done anything. It bounced a little bit and has just continued to drop. And this was after they reported earnings. So Canada's BMO profit misses on higher loan loss provisions, shares sink. Bank of Montreal on Wednesday reported weaker than expected quarterly profit, hurt by higher loan loss provisions, and it warned that fewer central bank interest rate cuts could continue to pressure consumers and businesses. The Canadian lenders' shares were down nearly 8% and on track for their worst day in over 4 years, guys. And think about where that puts you back to. You're talking about the stock market crash in 2020. That's when it would put it back to. So, you know, these banks are suffering major issues right now. It's obvious to say the least. And we've talked about this for so long. I remember beating the table about this, saying the banks are reporting record earnings, everything's going to be fine, but just watch out, because later on, those record earnings are going to come to haunt you. And especially when these banks pay out so much in dividends, and they're just reluctant to reduce those dividends because they know that so many people are just holding the stock purely for the dividends. So anyway, it's going to be incredibly interesting to see how these banks fare over the coming weeks and the next couple of months. I really think it's going to be crucial to see what happens, especially with commercial real estate. This is not just a problem in Canada, guys. I want to highlight, this is a global issue with commercial real estate that is affecting all countries, and Canada is obviously majorly affected because the amount of private debt that's out there is just unbelievable, one of the highest in the world. But this will affect the United States. It's going to affect Europe. It's going to affect the UK. It's just a case of who's going to get affected first and who's going to get affected the fastest. And we're seeing obviously Canada is really leading the race there, the race to the bottom, which is never good. So anyway, guys, if you've enjoyed this video, I would highly recommend that you check out this video here. If you're looking for a VPN to get around the censorship laws, go to expressvpn.com/marketmania. I hope you like the new background. A lot of people would complain about the old one. I will see you in the next one.